Hey guys, what's going on? I'm Jake. Welcome to my YouTube channel. Today the plan is simple. We're going to be talking about the easiest way to make money in the stock market. And it's not only one of the easiest ways, it's also arguably one of the best, if not the best way to make money in the stock market. If you follow what we talk about in this video, you might find yourself outperforming as much as 96% of actively managed mutual funds. And to make it even better, you're gonna get all of these results by doing literally nothing. As a matter of fact, the method we're talking about today is so good that this is how Warren Buffett, billionaire investor and owner of Berkshire Hathaway, has instructed his trustee to invest his assets once he's no longer investing. A lot of people at this point say, okay, is he gonna suggest Apple or Amazon or Tesla? And the answer is actually super simple. Buy all of them. Okay. You might not actually be able to afford every single stock in the stock market. I mean, one share of Amazon is a couple grand, right? That's a lot of money. But we have something called an index fund, which allows you to buy every stock in the stock market for the price of one share. Now think about this. When you go out to eat and you want to try a bunch of different foods, you don't buy all of the entire meals, right? You buy a sampler and it comes with a little bit of everything. An index fund is the same way. Now, the one I use is the Vanguard Total Index, or VTI for short. Now, the great thing about index funds is they allow for better returns, lower fees, and less headache than traditional investing. You never have to look at a company's spreadsheet. You don't have to read another article. You don't have to do anything. And you're also super diverse because your money is split across over 3,000 United States companies, which is phenomenal. Now, if you're wondering why your financial advisor hasn't told you about this yet, good question. Let's take a look at traditional advising and how it will affect your wealth over time versus something like a low-cost index fund. If you invested $100 a month for 30 years at 13% annual return, which is what we got over the last 10 years, which could be different in the next 10 years, right? Past results don't guarantee future results. Then you would have ended up with over $442,000. However, if you took just 1% of those returns and gave it to your advisor for fees, you would have ended up with only $353,000. That's almost $90,000 less that you would get because of that 1% fee. Now, if you took the alternative route, maybe your advisor just charges 5% flat upfront of your initial investment, you would have ended up with just over $420,000. So still you're losing over $20,000, but it's not as bad as losing almost $90,000. Now, we're at the point in the video where I need to say, I'm not a financial advisor. So just because this has been really good since it was created and has been shown to be one of the best investments possible, doesn't mean it always will be. Go ahead and ask your financial advisor how your portfolio would be if you'd invested in a low-cost index fund instead of whatever it was that you invested. And have them take fees into account because that's really important. Now, let's go ahead and continue talking about how you can be a stock market genius by doing literally nothing. When you invest in the stock, you have to get three things right. You have to know what to buy, when to buy it, and when to sell it. It's hard to predict. When you invest in an index fund, you're investing in the economy and not in a company. So you're expecting the economy to grow over time. And this has been the case in the US, and a big argument against index funds is the fact that you're getting all the bad companies, but you're also getting all the best companies. And in the modern economic era, a company doesn't usually just go out of business. Usually what happens is another company replaces them and then makes even more money and does even better in the future. Think of this simple example. We used to have horse and buggies. In the US, they were everywhere. Ford introduced the Model T. And because of that, the auto industry has exploded and is now so big in comparison to horse and buggies, you couldn't even believe it. So when we invest in the index, we're not as worried about the bad companies because we know that bigger, better companies will replace them over time. Now that we've addressed that, let's talk about the two big drawbacks of index funds. Number one, you're not going to hit a home run. You're not going to buy the company that explodes and can make you a millionaire overnight, but you're much more likely to be successful over a long period of time with this methodology. The second thing is that they are boring, and a lot of people have fun looking at their investments. It's not fun just to not see your portfolio grow that much overnight. It is fun to get rich when other people are still trying to figure it out. Now, if you're still watching, go ahead and like this video for the information you've learned today. Make sure you go ahead and ask your financial advisor how your returns have compared and if you should be moving your retirement accounts into a low-cost index fund. And finally, go ahead and subscribe if you're interested in getting more information on how to grow your portfolio, grow your wealth, and manage your money. I can't wait to go on this journey of financial literacy with you. It's going to be a lot of fun. I'll see you guys next time. Peace.